to the third installment of the Business Succession and Exit Strategies webinar. Thank you for joining us, and I invite you to stay tuned for more webinars in the future. I am Jeff Nuttall. I'm the publisher of the Northern Colorado Business Report, and I will be your moderator today. Before we get started, I want to reiterate how you can participate in today's webinar event. Attendees will be in listen-only mode on your phones and speakers, but we do encourage you to ask questions through the control panel on the right of your screen. We will hold these questions until the last 10 to 15 minutes of today's webinar and answer them during the Q&A portion. However, I encourage you to type your questions in while you think of them so that we have them ready when the time comes. The viewer window on the left allows you to see everything the presenter is sharing on their screen. Right now, you should be seeing today's agenda. We will again be asking 3 poll questions today, interspersed throughout the presentations. And now let's meet today's presenter, Susan Johnson, who will be discussing building your value and planning your future. Susan is the Director of Tax Practice at Brock & Company CPAs PC. She joined the firm in 1978 and works primarily with private-owned businesses and individuals. Her areas of expertise include the construction and real estate industries and estate and fiduciary tax planning. She has worked with numerous clients as they transition their businesses to both family members and outsiders. And with that, ladies and gentlemen, please meet Susan Johnson.
Thank you. It's great to be here today. I've looked out the window and it looks like we're having our first fall day. But again, thank you to the Northern Colorado Business Report for putting this webinar series together. It's called Business Succession and Exit Strategies. Last week's session featured Sandy Blaha. Sandy's presentation really focused on the importance of the people side of the business and the importance of identifying and assessing top talent, improving the culture of your business, improving your leadership skills, and enjoying the resulting increase in business value. And Sandy is right, but you can't be successful without the right people in the right spot. But I'm going to kind of turn it a little bit and focus my attention on building the value of your business by integrating your plans with your financial data. Hopefully I can help you attract that buyer to begin with, because one of the first things they're probably going to look at are your financial statements. So I hope to give you some answers to some of these questions. All of us have been, the panel members have been talking about how this is all kind of wrapped up together with where do I want to end up, assuming that you want to end up retired and have sold your business. You want to think about what you need in the future and will I get there. In that process, obviously taking a look at your business and how does it measure up to others. And finally, where my focus is, what steps can I take to improve my business? If you were here last week, I mentioned that I thought you were probably a small business owner, and likely we're here to try to find out what you can do to help sell your business. The Small Business Administration defines a small business as an independent business having fewer than 500 employees. I think that's most of us. In my client base, we have very few clients that have 500 employees. Just look around you and look at the gas stations and the flower shops and your doctors and physicians, health clubs, even the McDonald's franchises. These are all small businesses. And small businesses are very important to the economy. You can start with some facts from the Small Business Administration Office of Advocacy. So 99.7% of all employer firms are small businesses. Employer firms are companies that hire employees. In 2006, Colorado reported 127,000 small employers and 2,910 large employers. Small business employs half of all private business sector jobs. They pay 44% of total private payroll. accounts for 65% of the net new jobs created between 1993 and 2009. I think this is an important statistic that we need to pay attention to and nurture our small business climate here in Colorado, and especially northern Colorado. Small business hires 43% of the high-tech workers. Now, there are a fair amount of very small ones, 52% home-based, but then 2% franchises. Those can be fairly larger businesses. And small business produces 13 times more patents per employee than large firms. And I think back over my years during my career, and I have been really blessed to have been associated with lots of clients over the years. Very bright people, scientists, spin-offs from a lot of these companies around here, and they all got their start somewhere and have added to the economy. We live in northern Colorado with lots and lots of those kind of companies. There's also another segment of small business, and that's small family business. These companies kind of, well, I am concerned about them. Less than 1/3 of family-owned businesses survive the transition from the first generation. Well, if you think about it, the first generation was the entrepreneur with the dream. They are the ones who established the business. In most cases, they didn't purchase the business. They just started from scratch. They struggled. They borrowed money. They didn't take a paycheck. They finally got it figured out, got their feet on the ground, got the business built, and then ended up very successful. The second generation follows in the footsteps of the founder and may not have the same drive. And if the business is passed to the third generation, this generation just seems to think that it'll always be there. They definitely don't have that drive of that first generation. And the statistics back up my personal experience. Only about 13% of family businesses remain in the family over 60 years. We're going to have a first poll here. And I'm just interested in seeing where you are in your business and what kind of business you are. So if you answer these questions, how would you describe your business? A, retail. B, wholesale distributor. C, service or professional. D, construction. Or E, other business. And Jeff, if I could just ask you to monitor that and let me know how that vote is going.
Of course. We have 78% of the votes in, now 100. And the results are retail sector 14%, wholesale distributor 0, service professional 57%, construction 0, and other 29%.
Wow. Okay, so most of you are the service and professional area. Was that 57% is what I heard you say there. All right, that works, and retail 14%. So as we work our way through this, because what I'm trying to do is lay some groundwork, and then we'll get into some of the nitty-gritty of what you can do as you're thinking about retiring. So how long until you retire? Well, you need to kind of put this in perspective. You need to set that departure date and then start to ask yourself some questions. What does leaving your business really mean to you? And if you could leave the business sooner, would you? Those questions become important as you go through this process. You need to perform a preliminary needs analysis, and it gets to the very end of this series where we're going to be talking with John Claggett and helping you figure out what it is you need to retire. One thing I want to say at this point is that it would probably be important for you to start thinking about developing a personal budget. Do you have a desired successor? This is an important aspect of planning your exit. Owners have a can choose between a limited number of possible successors. They can choose to leave the business to a child or children, to a co-owner, to a key employee, or an unrelated third party. As you think about those, think about what additional training and mentoring that you need to do to make the process successful. And then finally, what is the value of your company? This is a difficult question to answer. I think about it, what my clients tell me, they always say, well, every company is different. I don't know what it's worth, but you sure can't go out and compare me to anybody else. I'm just so unique. And I agree with them. You are unique. The businesses are different, but there's still a way for you to figure out what that value is. So to summarize where we are, we need to think about the components of that comprehensive exit plan. So your owner objectives, where do you want to be and when do you want to get there? Take a look at your business and personal financial resources. How much is your business worth? And what else do you have outside of the business? While we're there, I'm going to help you look at some items and consider some items so you can maximize and protect that business value as you go down this path. And then finally, think about where all of this fits together with your personal wealth and estate planning. Now, the protect part is real important in this economy, so it doesn't take too many months of losses to just completely destroy the business. So getting out of the business, briefly, just talk about the process. You do need that plan, and we've talked about when do you want to retire and do you have a successor. Then, early in the process, please review and update your bylaws, your partnership agreement, and other legal documents. You may have employment contracts or incentive compensation agreements. Tony King will be talking specifically about some of these items next week, but pull those out. Those agreements were probably written at a different time, and your goals have probably changed. If you have a partner, you better have a buy-sell agreement. I've seen lots of those buy-sell agreements that were written a long time ago that use a formula to determine the purchase and sales price. This may or may not be the right answer now, so please at least take a look at that. And as an accountant and CPA, I have to throw this in. Take a look at your estate planning documents. In 2010, there's no estate tax, but the exempt amount is just $1 million in 2011. And it's just not enough for most business owners. If you think about the value of your business, add in some life insurance, some retirement plans, 401ks or IRAs, and then the equity in your personal residence, and you've probably getting above that $1 million. So talk to your attorney, your accountant, and get those estate planning documents. So for all of those things, not only business but personal, make sure you engage professionals and consultants. Then perform a thorough review of the business and identify your problem areas. There are various exit routes for business that I did mention. You can transfer ownership to insiders. Your kids may have started working for you when they were in high school. Are they ready to take over yet? Evaluate the process there. I had a client not too long ago, successful construction home builder. His son was interested in becoming part of the business. He went to CSU, received a degree in construction management, but when he got out of college, my client wasn't quite ready to retire, and his son really didn't have the skills to take over the business. They came to a very interesting compromise on that. The son went out of state for a couple of months, a couple of years actually. He worked for another construction company, built his skills independently, gained experience, and then when he came back to Colorado, his father helped him get back into the business. And at that point, he was older, more mature. He was able to understand the business, and he actually brought back some ideas that helped them all. Over the years, we transferred the business through gifts of stock to the son. One of the things we needed to do was do a valuation for that gift process. You can also transfer ownership to key employees. Again, this would require a valuation. You just can't give stock away. If you're going to give it to employees, it's probably compensation, and so you need to have a value of the stock and include it in their W-2s. So we needed a valuation for that. You could transfer ownership to completely outside parties, and this would be somebody coming from the outside that would buy your business. You do need to figure that out and have a value there. You could do any combination of the above. I've had clients that sold the business, at least a portion of the business, to key employees and kept 10 or 15 or 20%. They wanted some ownership, and then they got some dividend income in the future. It became part of their retirement plan. Finally, you could just liquidate the business. Liquidation is an option that you might consider if you've not yet identified a successor. It's not a bad alternative if you don't wait too long, but please just don't waste the company's resources. We'll move on. So why would you want to do a business valuation? I would suggest that you would want to benchmark the progress towards your goal and help you target a departure date. It would also help you measure performance and progress towards your goals. You definitely need a starting place so you can fit your goals to reality. How would your plans change if you thought your business was worth $1 million and it turned out to be $500,000, or the other way around? The value is really impacted by lots and lots of tangible and intangible parts of your business. And I believe you can improve your odds of success if you know what it's worth now and you can work at it in the next 5, 7, 10 years and increase that value. When I got into this business, I never thought about really how businesses were valued, but it all seemed pretty mysterious. But as you can imagine, there are all sorts of methods to arrive at value, and transfers of businesses happen all the time, and there are lots of parties involved that have adverse interests. So if you need to know what the value is so you can plan gifts of partial interest to your kids or compensate employees. And we will get into some of that detail in just a second. We've got our second poll question. So for this question, do you know or have a general idea what your business is worth? So yes or no. Again, Jeff, if we could have you let me know when most of the people have voted.
We're at 92% now. See if that finishes up here. Looks like that's all it's voting. And so the yeses are 64% and the noes are 36%.
Great. Okay. When I see that, it makes me think you've done some homework there. Actually, I'm kind of surprised at that number of 64% because this is kind of where we start. So you must have done some homework. Let's see if we can go forward with the business valuation portion of my presentation. I'm going to lay out some items here that really are the nitty-gritty of business valuation. But I wanted to start out with just a little bit of history. As you can imagine, the IRS has an interest in how we come up with value. You make gifts of stock, you need to have a value. You transfer stock to key employees. They need to pay taxes on it and have it included in their W-2. So the IRS in 1959 came out with Revenue Ruling 5960, and it really was kind of the start of the whole art of valuation. Things have continued to get more sophisticated, but we still go back to the guidelines that were laid down in 1959. So we'll start with that definition of fair market value. Hopefully you all have seen that before. The price at which property would change hands between a willing buyer and a willing seller when the former is not under any compulsion to buy and the latter is not under any compulsion to sell, both parties having reasonable knowledge of the facts. So, first of all, it has to do with property. In our case, it's our business. It also could be your car or your automobile. So valuation of property. We talked about willing buyers and willing sellers. I know that in some circumstances I've run across individuals that think they want to sell their business, but they probably really aren't ready yet. So they drag their feet and the deal just doesn't get done, or they throw out a figure that's way too high. And so it really has to be somebody that is ready and willing to sell. Neither one of which are under any compulsion to buy or to sell. And what this means is that there are no factors in there that would influence the price. So if you were having financial difficulties and had to sell and some stress there, that's probably not you're not going to get the fair market value. So those are the factors that come in there. And then finally, both parties need reasonable knowledge of the facts. Think back to your house. Your house is probably not worth as much if it has a faulty foundation than if it didn't. And you do need to disclose that. In the business sense, the buyer will do their due diligence and increase their knowledge of the facts. So I want to go through some of the factors, and got too far there. There are 8 factors in this revenue ruling. I'm going to talk about each one of them and have you go back and try to think about how it applies to your business. So the first factor to consider is the nature of the business and the history of the enterprise from its inception. So in the business valuation process, the buyer looks at the stability or instability of the enterprise, or they look at its growth or lack of growth, what kind of business is it in, what has gone on in the past. We go to number 2, and it talks about the economic outlook in general and the condition and outlook of the specific industry. So once you know the nature of the business, then the buyer starts looking forward and what's going on in that particular specific industry. Hopefully there's promise in the future. It's a high-tech. Things are moving along and they're at the forefront of it. It's not a old horse and buggy type of industry. Number 3, they look at the book value of the stock and the financial condition. So here they're going to look at the balance sheet and see what's going on there. Number 4, the earning capacity of the company. The buyer's going to look at the income statement. How much has it made in the past? How much could it make under different circumstances? Number 5 was the dividend paying capacity. Number 6 is whether or not the enterprise has goodwill or other intangible value. So the goodwill is always the big unknown, but you can evaluate goodwill by looking at how the earnings have gone. Has always been profitable. It's been more profitable than other like companies. If you think about the stock market, some company of similar size that only makes $1,000 a year is going to be worth less than that same company, similar size, that makes $10,000 a year. So you look at whether it has goodwill or other intangible value. Number 7 is the sales of the stock and the size of the block of stock. What this has to be is they look at prior transactions. Have there been other transactions of stock? Has somebody else independently come in the prior years and purchase that stock? The size of the block of stock to be valued is also important. If you buy 100% of a business, it's got to be worth more than buying 10%. You never want to be a 10% partner in anything because you don't have any control over it. So IRS realized, as the marketplace recognizes, that a 10% interest is worth less than a majority interest. And finally, number 8, it looks at the market price of stocks of corporations engaged in the same or similar line of business, having their stocks actively traded in a free and open market. This is where they can take your small business and go and compare it to publicly traded securities. But how do they do that? How do they take all of that financial data and do the analysis? Well, they go through in the process and look at your historical financial statements. You know, I'm kind of a tax person, and my clients in a lot of cases report to the IRS, and that's the books they keep. The buyer is not going to be real happy with those kinds of records, especially if you're cash basis. So a buyer would come in, or the seller if they do it ahead of time, which would be a good idea, convert your balance sheet from cash basis to accrual basis. Accrual basis just recognizes all revenue and expenses in the period in which they're incurred. Not only are you going to record accounts receivable, but you're going to adjust accounts receivable. Write off those bad debts. Don't carry those for a long time. In the inventory area, inventory is pretty easily manipulated if you don't maintain adequate books. So make sure you take physical inventory, record everything at its purchase price, not its current sales price. You know, record prepaid expenses and other current assets. But what I mean by this is that if you're preparing your financial statements for your tax return, you're going to prepay that January, February, maybe even March rent in December so you can deduct it. You've got an insurance policy that goes from November through October. You paid it in November, and so you've got a full year of expense. But if you get to an accrual basis, it gives a better picture. In real estate and tangible personal property, we are tax-focused and end up writing off assets a lot faster than they really their useful life. You're also going to look around and see if there are any intangible assets that you need to put on the balance sheet. Probably not for book purposes, but maybe. In the liabilities area, you're going to record accounts payable and accrued expenses. The auditors record a liability called deferred taxes that would recognize the income tax liability that you would have in the future for book tax differences. And then think about your contingent liabilities. If you go through a valuation process, you're going to have this great big interview with the person doing the valuation. And they're going to ask you about product liabilities, lawsuits, employment agreements. They won't book these on the balance sheet so much as they will note them for purposes of figuring out how to handle those in that valuation process in the future. So just look at the balance sheet. Let's look at the income statement. Going to look at various expense items. Compensation to owners is a real common item. I see it in my clients. You pay yourself kind of not only what you need, but how much is needed to kind of manipulate the income of the business. A buyer is going to look at that and say, okay, you paid yourself $250,000 a year. Can I hire a manager for $150,000 a year? Because they're going to look for savings in the future. They're going to look to see what they can do to integrate the business into their own business. Depreciation methods. We're going to go back to real depreciation methods, not tax depreciation methods. They'll look at related party leases and other transactions. Possibly you own the real estate and rent it to your corporation. Is it a real fair market value lease or is it not? Non-operating income and expenses. A buyer would eliminate those because they want to see what's real, what's not one-time events. And then they're probably going to book income taxes. Even if you're a S corporation or a partnership, they're going to do that so that they can do a comparison to the publicly traded data. So business valuation is typically based on past income and profitability. A buyer is going to project that income and profitability into the future. Look at business trends and industry trends. They're going to try to find out any unique characteristics or assets that you might have. And finally, they're going to compare it to the market. So the purpose of the business valuation is to protect the value from erosion and risk, find out what you are doing right, and find out what you can do to enhance the value. And then an important part of the business valuation process, so it doesn't have to be part of that process, is to help you estimate future cash flow. That business valuation process, you may discover weaknesses that you can improve on. And I think that this is kind of an educational process. I've had clients go through that, and during that interview process, they have to be very honest with themselves about what their business is really about, where it's going, where they're really good at things and where they're not so good at things, whether it's management or systems or retaining customers. And when you're compared to industry standards and benchmarks, you do find out where you are and what you can do in the future. So we'll look at some value drivers. The value drivers include, and what I mean by value drivers are things that would help you increase that value of your business. And it includes a stable, motivated management team. Sandy talked about that last week, and it's really important that your business really would be more valuable if it was more than just a one-man show out there. Value drivers also include good operating systems. And good operating systems, if you just think about some questions. Does everyone know what to do and how to do it? Who does it and when to do it? Get it down on paper. Document your systems. Buyers do love to find underperforming businesses where a combination of just good operating systems and operating improvements and growth can result in high returns. The business valuation should have helped you identify where you can make those improvements. So part of the operating systems, if you think about it, as simple as a staff manual. Do you have a staff manual where everybody knows what is vacation time and when do they get off for Christmas? What the hiring and retention process and evaluation process is. And this may seem fairly minor, but a lot of management time is spent if you don't have good systems. Systems of identifying customers and inventory control and fixed asset control, and then business performance reports. And finally, another driver would be just good and improving cash flow. So we're going to have our final poll, and after the poll we'll get into some suggestions for improving your cash flow. So this poll question is, when do you plan to exit your business? In the next 2 years, A, in 2 to 5 years, or in more than 5 years? So, Jeff, again, if you'd let us know when they voted.
Of course, we're at 83% right now. 92. I think the last one's cut off at 92, so let's just go with that one. All right, in the next 2 years, we have 18%. In 2 to 5 years, we have 27%. And more than 5 years, 55%.
I didn't hear you, Jeff. Did you say so?
Yes, I did. In the next 2 years, we have 18%. In 2 to
Okay.
5, we have 27%. And more than 5 years is 55%.
Okay, thanks. All right, so a great majority of you are at least in the greater than 2 and greater than 5. So I think that's great. That means to me that you've got some time to work on your value. So the last portion of my presentation is kind of twofold. I want to talk about improving cash flow, give you some ideas there, and then help you with maybe some specific strategies, maybe more short-term strategies that develop over into long-time results. So, in improving your cash flow, you know, we always say kind of like cash is king. If you had the cash, you wouldn't have to go to the bank. You paid all your bills on time. You could take advantage of lots of discounts. So let's just kind of go down part of the balance sheet and give you some ideas on improving your cash flow. In accounts receivable, you send out the bill. You offer some discounts for early payment. If they pay it in 5 to 10 days, give them a little discount. Take a deposit on orders. I have a client that's a manufacturer that, manufactures some specialized products. And so he has to go out and buy the materials ahead of time. He has a contract for the manufacturer of the product. Well, he started asking for about a 15% discount of deposit up front. That provided him some money. It didn't cover everything, but it provided him some money to fund the purchase of the materials and to start paying his employees. That has helped his cash flow. You should also track your accounts receivable to identify and avoid your slow-paying customers. So institute a policy of COD as soon as possible. If a client is going to always drag his feet, then the next time you do something for him, just make it clear that's a COD. That strategy is working quite well right now in this economy as people trying to use each other as their banker. Perform credit checks. Find out if that company can afford to pay you. Charge late fees. If they don't pay in that period of time that they agreed to, then charge a late fee. And then follow up on all your late accounts. Call your customer and send a letter when the payment's not been received. A personal little note from somebody, not just a little computer stamp, can really make the difference sometimes. Your bookkeepers and accountants are on the phone with those people. They know the names, so they could just write a personal note. Hey Joe, please send a check. We're late. Send out invoices the same day that goods are shipped, and then follow up on late invoices. In the inventory area particularly, remember that inventory is not cash. You need to minimize your inventory and attempt to forecast what you expect to sell. Finally, get rid of obsolete inventory. I've got clients with yards full of material that I really think they bought 10 years ago. And if they could just get rid of it might generate some cash to help them through this. But you need to attempt to forecast what you expect to sell and don't buy too much. I met with a client last week whose inventory had increased from $450,000 to $1.2 million. Now the season is in the fall, but it's still way too high, and he's having trouble paying some current bills. In accounts payable, it's on the other side of it. Arrange for a line of credit from the bank before it's too late. Ask your vendors for a discount for early payment, and then take full advantage of creditor terms. Don't pay things early if they won't give you a discount. Pay something else. Use business credit cards for travel, lodging, meals, and office supplies. This could, give you 45 days or so to make those payments. But, while we're talking about cash flow, I've got a couple of cautions. Always pay your employees because your business depends on those. And don't treat the IRS as your banker. The IRS just has no patience with that. You need to deposit those payroll taxes on time, file all the quarterly returns on time. It's tempting. I've seen it too many times. But by the time, if you do that once, then you have to do it the next time, and all of a sudden you're just way behind on getting those tax returns, payroll tax returns filed. So don't do that one at all. So in this final segment, I want to talk about some strategies that I think are most likely to build value. Here's one: manage with a scorecard. I first saw this, 15, 20 years ago. Had a client that ran one business full-time, but had another business where he had a manager. So he wasn't there daily. He knew the people involved, but he really wasn't there on a day-to-day basis. His second business was a turf farm, and he would go out about once a week or so and kind of check on it. He asked the bookkeeper to complete this little form he had before he showed up, and it had less than 10 items on it, but they were the important items that he wanted to watch. One of the things that he wanted to know was, the weather forecast, the temperature, when was it going to rain. It's kind of odd for him to be asking for that, I thought, but then I thought, that's what's important in this business. You need to cut that sod before it got too wet. You needed to deliver it when it wasn't too hot. And he was a great businessman. So he watched the temperature, he watched the number of pallets, he watched the retail customer count, which is important to him, and he was always looking at the age of the accounts receivable, really following up personally if his manager and bookkeeper didn't do it to make sure that they got paid. And the other thing, it was a daily report, not just or daily or weekly report at least. At the end of the month, he looked at the financial statements, which included, the important thing is he always got his financial statements by the 10th of the following month. If you think about it, financial statements are history. So the longer it goes, the more it just doesn't mean anything to you. So he got the statements by the 10th of the month. He compared this month to last month, this year to last year to date, and he had other stuff on the bottom of those financial statements that they just gave him, number of pallets, average temperature. Anyway, it worked real well. for him. And I think if you think about your business and know what those important things are, write it down. The industry calls it key performance indicators. It's used to define and measure progress towards your organizational goals. It needs to be measurable, and it must be key to your success. So try those little hints. Another couple of items to think about. Do you focus on maximizing cash flow or minimizing taxes? And I know taxes are not a pleasant topic, but people do need to, I believe, concentrate on cash flow and results of operations and not solely think about minimizing your income taxes. Yes, buy that computer if you need it. But make a contribution to your retirement plan. That's as deductible as buying that new computer. Don't go out and buy the fanciest car you can. Buy a more modest car. Excuse me. Okay, here's one that you know, when you become successful, you start sometimes treating your business as your personal checkbook. If you're looking forward to selling the business, you don't want to be making all these explanations of why you have those trips in there and why you have to, you know, I really made more money than it looks like because of all the perks that I had. So pay yourself a reasonable salary, I mean a good salary, but don't overinflate things as you're going down the road. Finally, hire the best in-house accounting staff you can. They are definitely worth it. They'll build your financial statements on a monthly, quarterly, annual basis so that you would have the records when you went to sell. So concentrate on establishing a consistent record of growth and profitability. Keep equipment and asset transactions on the balance sheet. In other words, don't just write off everything that shows up. I would suggest you maintain your books on GAAP, which is generally accepted accounting principles, not tax basis. Maintain accurate and timely financial statements. Here's one. File your tax returns on time. That's real important that you get that done. Develop a broad, diverse customer base. Develop your management team so that the owner is not critical to the operation of the business. And focus on earnings versus sales. Don't just make a sale to everybody that happens to come in the door. Make sure that you are a little pickier. Be selective and go after the jobs that you can perform profitably. That is the end of my presentation. Again, I'm with Brock & Company CPAs. We've been around over 54 years. We are not a family-owned business, but we are a small business, and we offer various services. I would love to have you contact me if I can help you. There is my contact information on that last screen, and I will turn it over to Jeff.
Well, thank you very much, Susan. That was very informative. And now it's time for the Q&A portion. And since you spent a fair amount of time talking about cash flow, the first question is, can I improve my cash flow by selling my accounts receivable?
Oh, yes. In this climate, there are companies out there that will buy your accounts receivable. Now, they won't buy them at face. So if you have $100,000 of accounts receivable, they're going to first look at the age of the accounts receivable, so they're going to buy the value, the current ones, higher than they'll value the ones that are 6 months old. But it would be a method of generating almost immediate cash and getting them off of your balance sheet and providing you with that cash. Yes. Thanks, Jeff.
Okay. And the second question is, can't I just give away stock to family members?
Well, again, we kind of have to go back to the IRS. No, you can't just give it away. You need to have that valuation and know what it's worth. Each individual is allowed to give away $13,000 a year, so that's cash or stock or birthday presents or anything like that. If you give away more than $13,000 per year to any one person, then you're required to file a gift tax return. And that gift tax return goes into your lifetime exemption of gifts. So no, you just can't give it away either to your children or your aunts and uncles or your best friend. You do need to have a valuation before you can do that.
All right. Next question is, what happens if I can't find a buyer?
Oh. Okay, part of my presentation, one of the exit routes that I talked about was liquidation. And if you can't find a buyer, then you essentially have to close up your business. And procedurally it's fairly easy, but it's time consuming. You need to sell all your assets. Depending on your structure, you may have a corporate level tax and then come back through to you, have an individual tax, but you would sell all your assets, kind of go into a period of time where you're not having any business, having any operations, convert everything to cash, and then liquidate it. There are income tax implications to that. You essentially don't get a premium for your business, and whatever it is worth in cash is converted to that point, and it comes into your personal estate.
The next question is, when projecting the business's income into the future for valuation purposes, how far into the future do you look, and is a present value methodology employed?
Yes. Valuators will take any trend they see and try to take it out at least 5 years, if not 10 years, and then you'll have a terminal value out there where they make some assumptions that it's either could continue at a certain growth rate or it'll level off. So yes, then you have a present value calculation of that cash flow back to today. So it's a very common way of valuing businesses, present value of future cash flow.
All right. And the last question I have is, how do I find a qualified company to value my business, and how much will it cost?
Okay. There are lots of qualified businesses out there. Brock & Company does do business valuations as part of our practice. There are lots of others out there. Even business brokers will do a business valuation. Probably I have to tell you that the best valuation you can have is probably from anybody that is certified by the American Society of Appraisers. They have a very high level of certification, and as you can expect, they're also probably the most expensive. If you went to somebody that is called an ASA, you would go to them probably for gift and estate planning. If you have taken some positions with minority interest discounts or with family limited partnerships, some of the very technical and complicated and probably riskier positions to take for gift or income tax purposes, you're probably going to want an ASA. Those valuations, I'm guessing anywhere from $8,000 to $25,000. Lesser levels of valuations are still very, very good valuations, but maybe wouldn't be used in those situations. Probably still in the range of $3,000 to $6,000.
Okay. And the next question is, when you talk about keeping books on an accrual basis, does this apply at every stage of growth? When you only have 1 to 2 employees, is it worth keeping the books on accrual?
I think so. I don't think it has anything to do with the number of employees you have. It's probably more the type of business. So if I go back to who we have here, professionals. Professionals and service providers. Well, if you mean by a service provider, a health service provider, you definitely need to be on the accrual basis. You need to know what the insurance companies owe you. You've got your receivables correctly stated. Your payables are probably not really significant because you probably don't have a lot of accrued salaries, but you would have payroll taxes and maybe some property taxes or things, but it would still be important to at least have access to accrual basis reports. A lot of the softwares this day, a lot of people use QuickBooks, at least the smaller companies. And if you look into the QuickBooks, you can set it up on accrual basis, but flip it when you print your reports and print a cash basis. So you'd have the cash basis for your tax returns, but then you're always keeping the accrual basis. And I'm not particularly promoting QuickBooks, but there are other software out there. But then QuickBooks can be used for your billing and others. Maybe not as a doctor's practice, but in others. So I would still suggest that you keep your books on the accrual basis.
Okay. I do not see any other questions. And so this will conclude the third session of our Business Succession and Exit Strategies webinar. The slide on your screen shows the remaining schedule for this webinar series. Thank you all for attending, and thank you, Susan, for a great job today. We look forward to discussing legal considerations and issues in business successions and exits with Tony King of Minor & Brown next week. Here is contact information again for all of our series panelists. I encourage you to reach out to them independently to drill down and ask more questions. Thanks again, and enjoy this finally wintry afternoon, everyone.
Thank you.